Ledger. 4 subtopics will we discuss. First, meaning and features. Second, needs and importance. Third, format of ledger. Fourth, posting journal entries to ledger. Introduction. The second step of accounting cycle is to post the journal entries to the ledger accounts. The journal entries recorded during the first step provide information about which accounts are to be debited and which to be credited, and also the magnitude of the debit or credit. See debit-credit rules. The debit and credit values of journal entries are transferred to ledger accounts one by one in such a way that debit amount of a journal entry is transferred to the debit side of the relevant ledger account, and the credit amount is transferred to the credit side of the relevant ledger account. After posting all the journal entries, the balance of each account is calculated. The balance of an asset, expense, contra liability and contra equity account is calculated by subtracting the sum of its credit side from the sum of its debit side. The balance of a liability, equity and contra asset account is calculated the opposite way, i.e. by subtracting the sum of its debit side from the sum of its credit side. Meaning of ledgers. A ledger is basically a record in which we record transactions of a specific nature. Every ledger relates to a particular person, asset, expense, or revenue. For example, most common ledgers show transactions relating to cash, bank, land, building, inventory, salary, capital, debt, etc. The most important function of ledgers is to sort individual transactions into separate individual accounts. They make it easy for us to group all transactions of similar nature and the same subject matter into individual groups. This, in turn, enables us to carry forward the process of accounting smoothly and effectively. The process by which we can do this is called ledger posting. Features of ledgers. Every ledger contains two sides. The left side shows debit entries while the right one depicts credit entries. Secondly, every ledger relates to a particular person, asset, income or expense. Therefore, every transaction affects some ledger regardless of whether it is a real, personal or nominal transaction. Thirdly, we can identify each ledger from the name of the concerned account. In order to do this, we have to write the name of each account on the top right in the middle. Classification. They can also be classified in the following two categories. First, permanent ledger. These are the ledgers having opening and closing balances which get forwarded to the next year. Second, temporary ledger. They don't have any opening and closing balance, and the account gets closed by transferring the amount to the profit and loss account at the end of the year. 5 types of ledger. First, bought creditors ledger. It is prepared for recording the transactions from whom the goods have been acquired in credit. It can also be termed as a purchase ledger. Second, ledger sales debtors ledger. In it, the transaction of the debtors, i.e. to whom goods have been depleted in credit, is recorded. Third, general ledger. In it, all the other accounts entries are recorded more than the sales and purchase accounts. It can also be termed as a sum ledis of all the nominal and real accounts such as A, C receivable, inventory accounts, cash accounts, investment accounts, machinery accounts, etc. Fourth, various subsidiary ledgers are prepared for providing details to the general ledger, and at last, all are summed up in one ledger called general ledger. Thus this account is also termed as master account or main account. Fifth, private ledger. It is prepared to maintain the personal records of the owner or the owner of the business, such as capital accounts, current accounts, drawing accounts. The following are the important utilities of ledger accounts. First, recording of transactions. Ledger account keeps a permanent record of all financial transactions in a classified manner. Second, providing information. Ledger account shows detailed financial information of a business regarding debtors and creditors, assets, and incomes and expenses. Third, preparation of trial balance. Ledger account helps to prepare a trial balance in order to check the arithmetical accuracy of the recording of the financial transactions of the business. Fourth, preparation of profit and loss account. Ledger account helps to prepare profit and loss accounts so as to ascertain the profit or loss of the business. Fifth, preparation of balance sheet. Ledger account helps to prepare the balance sheet with a view to show the financial position of the business. Format of ledger. This is the example of ledger format. Account types: asset account, account, cash. Example of how to make ledger. We have to always remember that the second step of the accounting cycle is to post the journal entries to the ledger accounts based on our previous transaction. Indoyo Company transaction. Indoyo Company was incorporated on January 1, 2020 with an initial capital of 5,000 shares of common stock having $20 par value. From this transaction, we have to make a journal. After making a journal, it will show two accounts: first, cash in debit, and second, common stock in credit. After making a journal, now let's make ledger. Cash is a part of an asset account, so write in the left top asset account. Next, we have to give a more specific account, so write cash in the middle of debit and credit, and write $100,000 in the debit column. Common stock a part of equity account. Same way we can use to make the ledger. Ledger balancing. At the last of the year, all the ledgers get closed by balancing the debit and credit balances of the accounts to find the difference amount amongst debit and credit items. If any account's debit balance exceeds the credit balance, then that account will be considered as an account with debit balance. Vice versa, if credit balance exceeds, it will be regarded as a credit balance account. At the time of closing of accounts, their balances get balanced or become nil, and the accounts which do not get balanced, nominal account, will be transferred to trading, profit, and loss. Purchases ledger control account. Purchases ledger control account is a summary account which checks the arithmetical accuracy of the purchases ledger. It enables us to see at a glance whether the general ledger balance for the purchases ledger agrees with the total of all the individual trade payable accounts held within the purchases ledger. Limitation of the purchases ledger control account and example. First, the error of omission, where a transaction has been completely omitted from the records. Second, compensating error, where equal and opposite errors cancel each other out. Third, error of commission, where an amount is posted to an incorrect account of the correct type. Fourth, the error of original entry, where an error is made transferring an amount from the source document into the book of original entry. That's all. Thanks for watching.